All right. Good morning, everyone. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo, yo.
It's shortly after 10 a.m. Pacific on October 3rd, 2025. I hope everyone is enjoying the start of autumn. And let's just jump into the tail of the ticker tape to see where we are for the month of September, Q3, year to date, and week to date. We'll try and make some sense of what's happened in the last quarter this year. So year to date, it's been a great year for equity market investors. The S&P 500 is up about 15% on the year, and in Q3 it was up pretty potent 8%. So September, ending the quarter with strong momentum, up 3.7%. So pretty strong momentum and great equity performance for those taking equity risk right now. If you want to kind of dig in and look at some alternative ways of looking at equity returns, if you were a value investor, year to date, you're only looking at the Russell 1000 value, you're only up a little bit shy of 12%, 11.7%. The third quarter, you up 5%, so you underperformed the S&P by 3%. And in September, you only up 1.5%, so you underperformed the S&P by almost 2%. So pretty clearly, the market is favoring growth stocks, which you can be seen by the Russell 1000 growth. On the year, it's up 17.25%. In Q3, it was up 10.5%, almost doubling the return of the Russell 1000 value. And in September, it was up a whopping 5.3%, almost triple the return of the Russell 1000 value. So pretty clearly a growth-driven market driven by the high flyers, the companies that are promising the moon. And if you're an investor who's allocated those, you've been rewarded with handsome returns. If you're a little more value conscious, you've still been rewarded. You just might have a little bit of FOMO when looking at those growth returns for the year, quarter, and month. And alternative way of kind of allocating capital, let's say you allocated capital equally to every stock in the S&P 500 and you were just agnostic. Well, if you did that on a year-to-date basis, you're up about 9.9%. In the quarter, you're up 4.84%, and in September, you're up 1.11%. So once again, you know, for those investors who just want equity exposure, you've been rewarded, but you've definitely underperformed those high flyers. And I think that's really the story of equities in the quarter and September and the year so far. What do you think, Mr. Kimmel?
Yeah, it just seems like equities continue to climb the wall of worry and really just, discount or ignore any sort of macro uncertainty or geopolitical uncertainty that's playing out in the background. And yeah, just keep racing to new highs just across the board, regardless of what index you're looking at.
Yeah, I tend to agree. It's definitely a risk on market and everybody's clamoring for, you know, the growth. When we kind of turn the page and kind of look at the fixed income markets, you know, it's a pretty interesting story there as well. I mean, the 30-year treasury over the course of the quarter, for example, went from 4.78% to 4.73%. So that's like, you know, a little bit of a rally there. You know, 5 basis point rally. You had a commensurate kind of, you earned your carry in bonds and you got a little bit of curve rally there. So in the quarter, the ag returned a nice, healthy, let's say, right around 2%. And when you look at on a year-to-date basis, the ag has returned over 6%. So bond investors are sitting pretty as well. You know, if you look at, for example, the shape of the yield curve over the quarter, the 2s 10s went from 61 to 54 basis points, where the 3-month 10-year went from 8 to 21 basis points. So kind of a interesting backdrop there. We at DoubleLine kind of think that the steepener trade has some legs, especially considering that the economy might be entering somewhat of a uncertain territory. Especially, we're flying blind from a data standpoint, which Ryan you'll touch on, but from just a um it just seems like the data we are getting is indicating an economy that's maybe at a stall speed, and absent shocks. So it'll be interesting to watch that develop. Last but not least, in the quarter and month, we're going to take a look at the commodity space. And commodities really had a positive quarter and September, but they were pretty dependent on the precious metal sector. In Q3, the commodity space was up over 3.5%, and in September was up over 2%, leaving the yearly return on the BCom up over 9%. But when you really drill into that, you have a mixed bag in performance. For example, the energy sector is down on a year-to-date basis. In the quarter, it was down over 3%. And let's say it was flat in September, you can then look at the agricultural space and it's been down about, call it 2.5 to 3% year to date. And in the quarter, it was down a little less than 1%. And in September, it suffered down over 3%. Now, what's the shining star? Well, the shining star is precious metals. Year to date, up almost 50%. The subsector. Q3 up almost 20%, and September up almost 12%. And, gold and silver are really shining right now. I mean, just drilling in and looking at gold, year to date, gold is up about 45%. In Q3, gold was up over 15%. And in September, it was up over 10%. So, I mean, pretty incredible performance there when you think about it, especially considering the dispersion you have with, WTI crude down on the year, down in September, currently trading at about $61 a barrel. Copper, an economic bellwether, is up 19% on the year. So that's an interesting data point. In September, it was up 6%, and it helped the industrial metals sector get a, let's say, 3.5% return. So I think all in, from my point of view, it's been a positive quarter and year for capital market participants. I mean, you made money in bonds, you've made money in commodities, you've made money in stocks. That said, it's a kind of a risk on market. So it's a pretty interesting situation. We at DoubleLine are definitely really trying to evaluate whether the markets are making sense, and we're trying to navigate this situation with a very sober attitude, and we don't want to get caught up in the momentum and hoopla. That's really all I have to say for the performance. What do you think, Mr. Kimmel?
Yeah, I mean, for the year, I mean, you could basically just throw a dart at the board with the different asset classes, and you'd end up with positive returns. I think what really sticks out to me are, that ma material increase, the surge in gold prices that we've seen this year, and really like, the near term momentum is incredibly strong, and it just seems like gold is finding support from not only like the fiscal sustainability issues in the US, but abroad. The US is not the only one that has problems with getting their, their government debt spending under control. You're seeing curves steepen, not just in the US, but in other developed markets in Japan and Europe, UK. And it just seems like gold is sniffing out some of these troubles with fiat currency, and perhaps some downside risks to currency markets, and long end government debt markets.
Yeah, I tend to agree with you there. We're definitely in a new regime from a global monetary standpoint, and the dam hasn't broken, but gold is indicative of capital allocators out there are definitely looking at gold with a little bit of I think it's used as a risk management tool for all that uncertainty that's kind of awash in the global financial system right now.
Absolutely. And you're even seeing like reserve managers diversifying away out of fiat into gold, which, you know, very large tickets here, big source of demand. I think that's also supporting the pet rock as well.
Yep, the good old pet rock, the you can look at it, you can pet it, but it won't really give you any love, but it'll be there. That's the thing, it's enduring. And, I'd be remiss not to mention that Bitcoin is also kind of at near record levels, currently trading around $123,000 US dollars per Bitcoin. So for all those crypto maniacs, Bitcoin is definitely holding its own right now. And kind of with that, we'll shift gears for the macro. What do you say, Mr. Kimmel?
Yeah, so I mean, what would normally be jobs week, given the government shutdown and the government's inability to come to an agreement to fund itself, we have seen delays to our official economic data. Just kind of focusing a little bit on the government shutdown. So the government has been shut down. I guess you'd call it like non-essential areas of the government have been shut down, which includes, the reporting sector of the government, so, the BLS. Um, and so that has led to delays of the initial claims data from the Department of Labor. And this morning we should have gotten the non-farm payrolls from the BLS, but we have not received that. And I think there's a lot of uncertainty just regarding this government shutdown on how long it will last. It's happened in the past. We've seen a number of government shutdowns. I think the longest one was in December 2018 that lasted 34 days. And if you look at the betting markets, like on Polymarket or Kalshi, they're putting a probability, like a 50% probability that this shutdown will last till, mid-October, and a 15% probability that it will last, into November. Which it's interesting because, we have the FOMC meeting coming up at the end of the month, and they're going to have to make a decision on monetary policy, and we might not have labor data or official labor data, or even CPI data, which comes out on the 15th of this month. So they could be flying blind to a degree. But with that being said, I think the hurdle for the FOMC to not cut rates is it's extremely low. Market is currently pricing in nearly 100% probability that they will cut 25 basis points at the October meeting. So I think even if we don't really get any official data, the direction is kind of set. Um, and then if you just look at like the economic impacts of shutdowns, government shutdowns in the past, it really doesn't have too much of an impact, as they are temporary, and employees that are government employees that are furloughed, they do get back pay. So it doesn't have too much of an impact on the data. But, this time could be a bit different, could see a larger impact, as, the Trump administration is saying that, they could make, some of these government furloughs, permanent. So, we'll just have to wait and see. I don't know if you have any color or comments on the government shutdown before I move into the economic data that we did receive this month, Eric?
Yeah, I mean, the government shutdown, it's unfortunate that the political leaders in this country can't do their job. But that said, I tend to agree with you that this shutdown could be a little longer lasting. I mean, it's already lasted a few days. It seems like it'll probably, at the minimum, go through the weekend. But negotiations are being had, and all we can do is cross our fingers and hope that kind of wisdom prevails and the adults in the room show up and negotiate to a solution. But that's really all I have to say.
All right. So, getting into the economic data that we did receive this week, we did get some reads on the labor market. We did get some official data before the government shut down from the job openings and later labor turnover survey. We also got some private data, which kind of points to this, a similar theme that we've been discussing over the last few months of just a labor market that continues to soften, and as Eric said, maybe approaching stall speed. Um, I think, what was the most interesting report this week, and definitely getting a bit more headlines, it was the ADP payrolls report for September, which actually showed that employment declined by 32,000 for the month. This was below the consensus estimate that was expecting a 51,000 increase in private employment, and the previous month was revised down to negative 3K from a positive 54K. So definitely looking like a slowing trend in payroll growth from the ADP report. If you look at the 3-month moving average running at 23,000, which is not that far off from, what we're seeing in the official non-farm payroll data from the BLS, which is, I think, the 3-month moving average is like 29,000 as of August. Another thing I'd highlight too within the ADP report is, small businesses continue to reduce headcount. If you look at the 3-month moving average of job growth with amongst small firms, that's at negative 24K, which actually lines up with, some of the survey data that you see from like the NFIB, small business hiring intentions. We have seen that kind of soften as well. So ADP report getting a little bit more focus with the BLS not reporting, and I think that's painting a picture of a softening labor market. On Tuesday, before the government shutdown, we did get the JOLTS data, the job openings data for August. So it is a bit lagged, as last data print was for August. It came in a touch above expectations, with the headline openings data at 7.2 million, kind of right in line, a touch above consensus, and a slight uptick from the previous month. The job gains were centered in the healthcare, retail, trade, and leisure, hospitality sectors. But some of your more like cyclical sensitive sectors like construction and manufacturing, they actually saw declines. Again, we're seeing this dynamic of this low hire, low fire environment. So the hiring rate that ticked lower to 3.2%, which is well below like the 2017 to 2019 average of 3.8%. And we did actually see layoffs decline as well. We also saw the quits rate decrease to 1.9%, which I believe is close to a cycle low. So, quit rates, I'd say that's indicative of employee sentiment on their ability to find a new job, and that has declined from very cycle highs we saw during 2022. And then importantly, you look at just labor supply demand dynamics. So you can look at the number of job openings as a proxy for labor demand versus supply, which is your total number of unemployed, and that dipped below a ratio of 1, which is signaling that, the labor market, the supply demand dynamic has come back into better balance, which in the end should continue to lead to normalization in wage growth and ultimately help the inflation backdrop in the US. This week, we also got a read on consumer sentiment or confidence from the conference board. It declined um, down to an index level of 94.2. And what I would highlight with this report is that the consumer's assessment of the labor market, declined to a new cycle low. So consumers are just indicating that they see that the labor market and job availability is lower than we've seen in the previous months. So another read that just the labor market is softening to a degree. We also got ISM manufacturing and services for September this week. we saw manufacturing continue to remain in contractionary territory below 50 at 49.1. Um, Services contracted to 50, which is just right on the verge of contraction territory. And when you look at the underlying details of these reports, I'd say they're kind of weak. New orders for manufacturing was in contraction territory. We did see a decline in the services as well. And then, importantly, just looking at the employment components of both manufacturing and services, they both remain in contraction territory, which just points to, these are diffusion indices. This points to just a narrower group of sectors, industries, or participants adding to headcount, which actually lines up well with what we were seeing in the official data, where you know basically like 90% of the jobs added this year are coming from the education and healthcare services components. So that that's it's always interesting when the private data, the survey-based data is lining up with the official data. I think it gives you a bit more of a signal there. And then finally, within the ISM reports, we got, the prices paid component. So, the share of manufacturers and service providers that are seeing input prices higher than the previous month. And, those are both well above 50, a bit more higher for the services. So that, this does put some upward pressure on the inflation prints in the near term, which is, I'd say, being priced in by the markets to a degree. Just looking at where inflation markets are pricing CPI going over the next couple of months. And then finally, we did get a read on home prices. We did get the S&P K Shiller 20 city composite home prices. Those decreased again during the month, down 0.07%, which was, I think, was the fifth consecutive monthly decline in home prices, which brought the year-over-year pace down to 1.8%. So, as we've talked in the past, home prices, seeing disinflation and outright deflation in home prices, could eventually feed through into lower shelter inflation in the official CPI data, which should help normalize some of those inflation readings that we're seeing over a little bit of a longer term horizon. So that wraps it up for the economic data releases this week.
Yeah, I mean, I think that that's very comprehensive, and particularly on that last point regarding shelter prices. I saw an interesting interview with the new Fed governor Miran, or is it Myron? How do you pronounce his name, Mr. Kimmel?
I'm gonna go with Moran.
Yeah. So, anyways, listening to him speak, and one of the key, I would say, keystones to his thesis on why he believes rates should be lower is he thinks that inflation expectations right now are different than what he believes the real time trajectory of inflation is. And a big part of it is the housing market. He thinks that kind of rents have caught up to elevated housing prices, but he thinks that there's going to be maybe stagnation or even some slight deflation because housing prices do not continue to appreciate. Now, naturally, the housing market has a high um, beta, let's call it, to interest rates. So if interest rates drop, it should stimulate activity in that space. But anyways, I just thought that was an interesting kind of linchpin to his perspective on why he believes that the Fed is not looking forward at what's going to happen. But with that, we can kind of look at what's expected from the market regarding cuts. I mean, at the October 29th meeting, there's pretty much a lock for another cut, and there is the expectation of another cut in December as well. December 10th is that final FOMC meeting of the calendar year. Um, Looking forward to next week, depending on whether the government reopens or not, it'll change the data that's coming out. But I would call it a pretty light week next week. I mean, realistically looking at it, you get the FOMC meeting minutes, you get consumer credit. I mean, you would get initial jobless claims and continuing claims, but that might not even happen. And then you get wholesale trade data and the University of Michigan sentiment data. But I would say it's a pretty light week next week. What do you think, Mr. Kimmel?
Yeah, the light weekend could be extremely light if we don't get some of that government data. It's a shame, like if we can't get our weekly initial jobless claims, because that's what I'm really focusing on. We're in this, as I said before, this like low hire, low fire environment. So, even though we're not seeing much of the way of job growth, like we're not seeing a uptick in layoffs. So I'm really was looking towards these jobless claims to see if we're, for any sign of an uptick in layoffs, but we're not going to be getting that data, it looks like, until the government reopens.
Yeah, hopefully these politicians are burning the weekend oil and kind of in the smoke-filled room, so to speak, and getting that government reopened, but we'll have to wait and see. And that wraps it up for the week.
Yes, thank you to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. One thing to keep an eye on is we have Sherman on Bloomberg Real Yield Friday, October 10th at 9 a.m. Pacific time, noon Eastern. And I want to give a thanks to all our listeners out there today and I hope you enjoyed the podcast.
Thanks, everyone. Take care.